All right, guys, we got a very interesting conversation for you today. We're going to share a little bit about the commercial lending space, what he offers, the type of services. So stay tuned. It's going to be a good episode.
Hi, my name is Michael Saunders. I'm the founder and managing partner of Fuse Financial Solutions. We focus on business finance, equipment finance, any type of business loan or working capital that you need to grow.
What type of commercial loans do you offer? If you could speak a little bit about the services and all that.
We focus on equipment finance, we have commercial mortgages, we have franchise finance, we have working capital, and pretty much any type of business loan that your client's going to need to grow their business.
Mm-hmm. So, okay, like when we say like commercial, like business loan, like are we talking like 100%, 80%, 50%, like financed by you guys? Like what are we talking about? What can people expect, basically?
Yeah, financing can range anywhere from newer business may require a down payment, but in a lot of cases with good credit and prior entrepreneurial history, we can sell it to the funder with 100% of the funding covered.
Wow, that's pretty crazy. Yeah, 100% is pretty nuts.
If you're getting 100%, that's typically a less risk profile, and that will typically come with a better rate.
100% is less risk?
100% is going to be for somebody who is less risk.
True, wow. I would think it would be the opposite.
Yeah, no,
yeah. Because I would think that like if they were putting in money, that like it would be some less, like if you were fronting 80 and they were doing 20, that it would be less risk for the lenders, but why not? Like why is that the case?
Yeah, I understand why you think that way,
yeah.
But it's because they want them to have skin in the game, and they want to reduce the risk, which is where the down payment comes in.
True. Okay, got you. So let's say first-time franchise owner or business owner, they're looking to get a loan with you guys. Like, what does that process look like? The application process, how long does it take for approval, and things like that?
Yeah, so the whole entire process will likely take 3 to 4 weeks from the time we get into it, pull it apart. We're going to need the contracts with the franchisor. We're going to need all the financial documents that we'll have to get in a row. There will be contracts, there will be due diligence, and we can have the funding set up within 3 to 4 weeks.
You would recommend people bring you on or contact you sooner than like 4 weeks, maybe like a couple months ahead, so that like they can start to get their ducks in a row, or where do you fit into the process of like, let's say them opening a store? Like when should they bring you on?
Yeah, when you are 50% certain that you're going to move forward with the deal, it would be wise to start having a conversation about those so that you can get everything figured out,
yeah.
And make sure you're making the right steps and that you're managing everything on the back end so that you keep things clean, yeah. And we're able to present you to the funder as the least risk profile possible.
True. Okay, perfect. So if we wanted to if someone was like, I want to guarantee that like I am getting approved, what would be the optimal person and I guess the optimal position to make sure they get approved for financing for their business or equipment loan or anything like that?
It really depends on what type of financing we're going after, but in almost all cases, having some experience in the industry or some sort of reason for the funder to believe that you're going to be competent within the industry is really important. Let's say it's somebody buying an A&W franchise. Sure. We're going to want somebody who has experience within the quick service industry. That's going to be the first and foremost. A lot of funders, it's not to say that it'll never happen, but a lot of funders are going to look at that and say, okay, this is somebody who understands the industry and is going to be able to hit the ground running if we give them the capabilities to do so. Again, not to say that if they had experience, owning a Canadian Tire previously, that entrepreneurial experience does help us. Coupled with good, strong credit, you're going to want to keep your credit strong and clean for the 6 months prior to applying and making sure that you're maintaining at least a 700 credit score during that period.
Mm-hmm. So 6 months is that sweet spot. They look back 6 months, would you say?
I say 6 months because it's the amount of time it would take to, things happen. Sometimes, they take multiple, credit inquiries can bring down your credit score. You can typically take up to 3 to 4 a year without it really affecting you over the course of the year. But a lot of people, are checking different things, or if they're going for mortgages, they go to different institutions, and that can have an effect. So I say 6 months because that's about the time it would take to recover from that and make sure that you've given yourself the best possible opportunity to present yourself to the funder.
And what like options, let's say if you had someone that had bad credit, do you have like A lenders, B lenders? Like what are the options available to that demographic of people?
Yep.
You know?
So we're able to facilitate for all different credit profiles. And going back to what we were talking about with experience, that can play into being deemed a higher risk, but we can still look at different funders, and everybody's got a different appetite for what type of asset it is, the resale value of it, and the type of industry that it's being financed into.
Okay, so is collateral or a personal guarantee needed for a commercial loan or for the equipment loans and stuff like that? What are you backing that loan off of as well?
So in a lot of cases with equipment finance, the piece of the asset that you are financing is the collateral. If you've had a troubled credit history, there may be asked for additional collateral or a guarantee, but in most cases, the asset itself is going to be the collateral.
So if you don't pay, they're taking back the asset?
That's right.
Okay. Well, what are they doing with all, like, let's say you bought like 30 mixers, you can't pay anymore. What are they doing with these 30 mixers after that?
Yeah, and that's why the type of asset and the type of industry that it is, it really comes into how the risk is deemed. Because if it's 30 mixers, they're used mixers, you're going to get pennies on the dollar. The funder's not going to be able to recover. They may look at that transaction as a higher risk and just deem it, whether they build it into the rate itself or into the term, they will build that in.
Okay.
If it's construction equipment, those are maintain value and do not depreciate. That gets treated different than, say, if it's an aesthetic laser.
Yeah, for sure. I could definitely see like if there was some construction equipment someone was getting lending for, that'd probably be like a bigger piece of equipment, you know what I mean? Which would hold the value well. You're not getting for small tools and stuff like that, Well, hopefully not. I guess everybody's different, but,
Yeah, the nature of the asset itself is those bulldozers, dump trucks and stuff, they're meant for wear and tear. And as long as they're kept on a proper maintenance, they don't depreciate very heavily. Obviously, everything depreciates once it's driven off the lot. It's not brand new. But aside from that, the depreciation is extremely slow. So those assets maintain their value, considered lower risk because the resale is, quite easy. Anything that's not specialized is going to be, like if it's a dump truck, if it's not a great asset, but like a hospital bed is a hospital bed. So that's more for just the thought of it. It can be resold to any hospital, and there's going to be a market for that. So it's treated by the funder. It's like, okay, this guy defaults. There's something called PayNet, and they can go in and they can see, how has your payment history been. They can see, is it, between 1 and 30 days, how many times payments have been missed or delayed. Do they have a clean business bureau? Is the asset resellable? And how's the personal credit in the case that they need a personal guarantee by the company? If it's a company that's been around for 25 years, has financed 100 pieces of equipment, and has always paid the bills on time, a lot of the time they will not require the personal guarantee.
Right.
If a doctor is starting a new venture, going into the aesthetic industry, and they are looking to buy an aesthetic laser, they'll put a personal guarantee on that. There's a whole lending industry in the software. And a lot of this stuff is tendered to specific applications. If Olive Tree wanted to specialize in a software and they wanted to finance that, that would be considered a highly specialized software, and it would carry a higher risk because it's not resaleable to.
Right.
But in construction, if it's a excavator, it's called a yellow iron. And if it's a yellow iron, it's a bulldozer or a dump truck or an excavator is exactly what it is. And the next guy that needs one just needs exactly what it is.
Okay, so in terms of like repayment terms, like what are we looking at, like typically,
For smaller loans, they can range anywhere from 3 to 6 months. And for larger loans, equipment finance or franchising finance, we can go right up to 84 months.
84 months, wow, okay. Yeah, that's plenty of time, So what like typical interest rate is someone looking at when they're pursuing a commercial loan or financing from you guys?
Yeah, so it really does depend on what type of, whether it's a business loan, whether it's equipment finance or franchise finance, but the rates right now are falling anywhere between 7 and 13% for the majority of the deals. Obviously, there's always outliers. If we have a stressed credit profile, those can go a little bit higher.
What sets you guys apart from your other traditional lenders? You know, why go to you guys opposed to, let's say, a bank or to a different commercial lender?
So in a lot of cases, clients are not going to be able to go to their financial institution for a myriad of different reasons. The other limiting factor is a lot of the time, if somebody wants to go after some sort of personal mortgage, whatnot, if they take lending with their financial institution through their business, it's held as exposure against them as personally. The funders that we work with do not contribute to the exposure for your personal.
Also, they don't have you don't have to basically personally guarantee any of that stuff. It's just straight with your corporation.
So if you bank with RBC and you go take a business line of credit, they are going to, and it's for $100,000, that's going to show on your personal as exposure. So if you want to go for a personal line of credit, they would say, listen, we've got full exposure with you. Whereas if you lend with our network of alternative funders, and their names that you've heard of in the past, that does not affect your exposure with your financial institution.
And what are some of the lenders that you work with? Like, if you can give us some names.
Yeah, we work with Mitsubishi, we work with CWB, we work with Meridian, we work with Bennington's.
We talked about late payments, we talked about missed payments. Like, what if someone decides to pay early? Is there any things that are done in their benefit if they decide to pay early?
In some cases, there is interest forgiveness. It, again, depends always on the type of funding you've received and how it's contractualized. That's a conversation we will always have when we're going through the contract together.
Yeah, and interest forgiveness, were we talking 1% or just one payment or two payments?
Yeah, so depending on the type of funding that you've received, it can be up to 25% of the interest.
Oh, that's great.
Of the remaining interest.
Of the remaining interest, yeah, left to be. That's fantastic.
If it's equipment finance, those are typically, a lot of the companies don't provide an interest forgiveness. It is a fixed term contract. If you show to be a good client, they want to help you out. Yeah, some of our preferred partners are really nice, are really fair with our clients, and they will provide an interest forgiveness of up to 25% for the working capital loans. Some of the equipment companies that we work with also provide what ends up being maybe 1% returned for an early payment, and that's typically eligible after 12 months.
Oh, okay. So you have that minimum of 12 months you need to meet, and then you can have the interest forgiveness.
That's right.
Oh, perfect.
That's strictly for equipment finance.
Equipment. Uh-huh.
You have to assess the situation, and we never want a client to run into financial hardship because the thing that's supposed to be growing their business, that asset is supposed to be a cash flow producing asset. We don't want that to be something that's handcuffing the growth of their business. Yeah, it's not in our interest, and the hope is always have a conversation hey, we're doing you a solid, we hope to see you again.
Yeah. True.
At the end of the day, there are always different options available, and we can get creative with solutions. Nothing is set in stone. We should always have a conversation to find out what your options are.